Good day, fellow investors. We got to talk about the UK financial shit show that has been going on this week. And it's not me saying that, it's the Financial Times saying how it was a proper shit show. And this has extreme consequences for the world we are used or we have been used till now, and how that is changing, because there are forces that simply don't work together. On one side we have inflation, and on the other side we have governments printing money and giving money to people to fight that inflation. That's crazy, but that's the world we are living in, and it is a shit show. And we just did Seth Klarman, Margin of Safety, Chapter 4, and JDR said one thing created in the UK out of nothing were pension funds return on investment. That's what the financial system does, and then you have these crises. And these crises usually happen when the financial environment changes. And what has changed recently? Well, interest rates went from 0 to now 2.25, a little bit higher in the US, and nothing yet started in the EU, but already this, on this smaller countries, has had a huge impact. And we can see here the pound losing 25% of its value against the dollar because of the fundamental issues. And the fundamental issues are so big that instead of doing stimulus, UK politicians might need to go to austerity cuts to calm the markets. Instead of doing tax giveaways, so Chancellor Kwasi Kwarteng wanted to do 45 billion tax giveaway on top of an energy bill rescue plan costing over 100 billion across 2 years, with no details on how to balance books. That made the market go ballistic, because on one side the bank is fighting inflation, on the other side you want to stimulate the economy for more growth. This simply doesn't work. So higher interest rates on one side, on the other side printing money, stimulating for more growth. That's one part of the shit show, and it represents politics against economic reality, and this is the issue we will be talking about over the next decade, I think, if not more. Then we had a pension fund issue that we'll explain in a moment, but rising interest rates on one side, and then the Bank of England pledges unlimited bond buying to avert imminent UK treasuries gilts crash. Unlimited bond buying. Are we back to 2009? Aren't we supposed to increase interest rates? Aren't we supposed to lower central banks' balance sheets? What the heck is going on? Well, tax cuts made the market go ballistic, and the weakest links crashed. And the weakest links are defined benefit pension funds in the UK. 2 trillion of those. Just one side of the market, liability-driven investing, another thing to learn what it is, and tightening leads to issues, and those that are not strong have some trouble. And not strong are pension funds. So we have pension funds. They had to live with 0 interest rates, low yields on bonds, and they went then to more sexy things like stocks, and that might not always match the liabilities they have in a defined benefit pension plan. You can pause this video. This is an insert from the Financial Times. You can read it for more details on the issue, but the thing is that there were asset and liability mismatches. They hold stocks. If stocks crash, if bonds crash, they need to pay up with their derivatives, whatever. And they started selling bonds. That crashed the market, and the bank had to intervene to save the UK gilt treasury market. Bonds fell more, margin calls, whatever, a normal market crisis, because markets are non-linear, and the Bank of England intervened like every other bank or politicians do. Politicians want to print money, banks intervene at every hiccup. This cannot go on forever. Then a weak pound, as the bank intervenes, is making Britain's energies even more expensive, which means more inflation, And if you stimulate more, then you have even more inflation. And I've seen that already. I've lived to that party. Look at my billions here when money becomes worthless. That's what's going on in all global economies, developed global economies, somewhere sooner, somewhere later. That's a fact, and that's why this is so important. The next thing to talk about is non-linear markets, because this is linear and then things change. When things change, things start to get ugly for a lot of people. In the UK, you only have maximal fixed interest rates of 5 years on a mortgage, because the UK knows that sooner or later a shit show will start, and therefore there are no 40-year mortgages. Then, as there are no 40-year mortgages, those that have variable interest rates are screwed. And then here we have the UK mortgage turmoil threatens a 70% surge in average costs, and you can see monthly mortgage payments double very easily. And if your salary doesn't double, you as a mortgage owner does, I don't know, 50% of the market in the UK, 50% of people are screwed. And this is beautiful how to explain the market. A week ago, the Bank of England hiked interest rates by 0.5 point. We are going to fight inflation. 7 hours ago, UK mortgage turmoil threatens a 70% surge in average cost. That's the limit of central banks. At some point in time, you create turmoil more than the benefit, and a shit show happens. And that's the non-linearity of markets. Nothing happens and then a disaster happens. And this has huge repercussions for where we live in, for the world we live in, and for how economic and central bank policies and government policies will be managed in the future. So this was, again, a week ago. The plan for governments is always the same. Stimulate, and hope that the growth will save your behind. And what are the politicians going to do with the next hiccups? Are they going to tell you, okay, inflation is 25%, you lost 20% of your purchasing power, so tighten your belt a little bit, we're going to do even more tightening because we need to solve inflation this time? Are they going to say that? Or they're going to make new tax cuts, give you money to pay for your energy bill, etc. And on top of everything, with the money printing and everything, and with seeing what happens with higher interest rates, it's interesting that the markets go down. So even that, when there is a liquidity crunch, even if the currency is worth less and less, the businesses, the reality goes even down with it, which creates an opportunity for those who have liquidity, not worthless liquidity. So I think the answer is clear. What are politicians going to do? Fight inflation or help with your mortgage, which leads to very, very tricky, slippery slopes down the road from higher interest rates. At some point, it's going to be impossible to hike more. The ECB hasn't even started properly hiking because they know that the weakest link, if they start hiking, it's over. They will have to start soon because everyone else is hiking. The euro is going down the drain. So it's insanity. And as a YouTuber, I can say it's going to be a fun thing to watch and comment on YouTube. As an investor, I would say prepare your liquidity because it will be buying time to buy absolute non-linear market bargains. Thanks for watching. I'll see you in the next video.